Morning, Manooj. How are you?
Good morning, Hector. I'm good.
Good to have you here. And we're putting down some more history today. Just give us an introduction to yourself, Manooj. I mean, a lot of people will know you already, but for those that don't, give us an introduction to you and just name the first two ETFs that came to Europe, if you can.
Yeah, sure. Manooj Mistry, COO at HANetf. I've been in the industry now 32 years. Started my career in a small boutique, which specialized in doing tax shelter investment products, but I also did asset management there and even had a stint as an active fund manager in my first 5 years.
So we can get you working on our portfolios now then,
exactly,
can we?
Yeah, exactly. And then after that, in summer of 1999, I joined Merrill Lynch. Basically, they had a project to launch the first ETFs in Europe, and that was where the STOXX 50 and Euro STOXX 50 leaders came out, and they were launched in April 2000. And I continued to work at Merrill Lynch until 2006, and then I joined Deutsche Bank, and there Deutsche Bank had a project to launch ETFs, and in on the January 2007 we launched the X-Trackers ETFs, and
the world famous X-Trackers.
Exactly, yeah. And they are still the largest organically grown ETF provider in Europe, number 3 by assets, but was there in total 14 years, 6 years on the sell side, 8 years on the asset management, and there basically towards the end I was looking after all the indexing business across ETFs and funds and mandates. And then I came across, obviously I knew you for a long time beforehand, but then had the opportunity to join Han at the beginning of 2021 and been here ever since.
Yeah, I think we tried your scorecard 2 times for a dance, didn't we? And we finally got you in the third time,
exactly,
right?
Yeah.
But, very good. Well, tell us about the first 2 ETFs in the European market. Tell us the names, and a bit of the background, how they came around.
Yeah, sure. The STOXX 50 and Euro STOXX 50 leaders. The brand leaders was basically something Merrill Lynch came up with at the time based on the success of what were called holders products. And these were depository receipts, and they were basically linked to a basket of stocks. And at the time in 99, late 90s, they were all on tech stocks and telecom stocks.
Right.
So
nothing's changed then.
Yeah, exactly. So yeah.
Not the same tech companies though, right? They're all a bit different now, aren't they? Yeah.
So on the back of that, LDRS was the name that we came up with. And the background to leaders was basically the project had started in 1998. And the precursor for that was basically success of the ETFs in the US, so SPY, QQQs, and Merrill Lynch as a trading house thought that they could kickstart an ETF a business in Europe. And Merrill Lynch partnered basically with the companies or the organizations that were part of STOXX, which was a new index provider. And STOXX at the time was a partnership between Dow Jones, the Deutsche Börse, the Paris Exchange, and the Swiss Exchange.
Right.
And basically STOXX wanted to come up at the launch of the euro with a pan-European benchmark, and that's where the Euro STOXX 50 index was born. And basically they wanted to create futures, other exchange-listed sort of a derivative products, and then also the ETF was seen as a sort of a natural progression from there.
Yeah.
So I joined Merrill Lynch in the summer of 99, and the reason I was brought in was that the project wasn't going anywhere. So my boss at this time said, I want to bring you in to get it done. So my job was to get it done. And we launched the first ETFs in April 2000. It was
just had the 25th anniversary, right?
Exactly, yeah. And it's funny, at the time, like we knew BGI iShares was also launching the first their ETF, and we knew it was on the FTSE 100.
Right.
So it's basically, we knew they were listing on the London
Stock Exchange.
Race, yeah. So I always say it was a bit like the Americans and the Russians with the race to the moon.
Yeah, who was who?
We were the Americans, we won. So we basically launched 2 weeks ahead of the iShares product on the London Stock Exchange, and we listed it on the Deutsche Börse. And initially, the ambitious plans were to launch on all 3 exchanges at the same time.
Right.
But we soon discovered the intricacies of European regulation.
You
and
would have
listing,
passporting and
all that, exactly, yes.
registrations and all that back in the day, right?
So,
I mean, people think that's a problem now. Imagine what it would have been like back then.
Exactly. And there was a bit of politics involved as well. But basically, we could only list in Frankfurt, and so on the Deutsche Börse. And then the others followed at a later date.
Yeah. What were the tickers?
For the Euro STOXX 50, it was EUN2. And for the STOXX 50 leaders, it was EUN1.
And do these exist today still, these products?
The products are still around. Yeah. So the
Same tickers?
Different tickers. I think the tickers are the same. The names of the products, they're now branded iShares.
Yeah.
But the STOXX 50 leaders is around $600 million AUM. And the Euro STOXX 50 leaders is about $6 billion assets.
Crazy, isn't it? Yeah. I mean, it shows you how much like legacy assets stay in products, don't they?
Yeah, exactly. Yeah. And they've had a few fee cuts since they were launched. So when we launched the first ETFs, they were 50 basis points. But now they're being offered at 9 basis points. So yeah, the prices have dropped.
Prices have dropped. Well, prices of the markets or prices of the ETFs themselves? Yeah. Obviously, you were really walking on virgin snow with this stuff, right? I mean, what were the major challenges you had when you took this task on? What were obviously there was some roadblocks prior to because your boss brought you in to move the project on. What did you encounter? What issues did you have?
So there's obviously two sides of it, like building the product and making sure that you could build the infrastructure. And we were working at the time with Bank of New York, Tony O'Brien, who we know well.
He always references these times. In fact, we probably should have had him in another seat there,
yeah,
shouldn't
maybe
we? Yeah,
invite him along
the
next
story,
time.
Yeah.
So we worked closely with Bank of New York to set up the product operationally, how it's going to work, how things like in-kind creation redemption was going to work. Also just in terms of the plumbing, in terms of how the shares were going to settle. So Tony and I created the first global share certificate for ETFs.
Right.
So we did all of that. But then the more challenging part was the regulatory landscape. And at the time, like we're now on the 5th incarnation at UCITS.
Yeah.
But when we launched the first ETFs, we were still on the first incarnation.
Yeah.
And what in those days, UCITS basically it allowed for pan-European passporting, but the passporting time was 60 days.
Right.
So you would never have survived in that climate.
Yeah, that would have been crazy, wouldn't it? Yeah, you'd never get anything done. Yeah.
So it used to take 60 days. And in those days, also regulators, if they wanted to, they can wait until the 59th day to object, and then you'd start your 60 days again.
Oh, wow.
So did
that happen?
It did, yeah. So it happened with in Italy, France, where we were trying to passport. And at the end of the day, what we saw was that the UK and Germany were the most friendly regulators in terms of passporting. Switzerland was quite funny because obviously Switzerland's always been outside the UCITS framework, but they recognize UCITS. But I remember being in a meeting room with the Swiss regulator at the time, back in December 99. We were trying to explain to them what an ETF was.
Yeah.
And the guy was saying, but why would anyone want to buy this? Why would investors want to do it? So it was a journey in terms of educating.
He turned up in his horse and went away in his car. Yeah, exactly. Is that what it was? Yeah.
But then, and then also like when it came to listing ETFs on the exchanges was quite funny because the exchanges had rules for listing companies, but they didn't have rules for listing funds.
Right.
And when we did the first listing applications, even though the business people at the Deutsche Börse were very supportive, the listings team didn't have a clue. And then basically they were asking us to provide 3 years of financial accounts and all of that.
Right.
So we had to get some exemptions.
Around round hole type thing, was it?
So we had to get exemptions to list the ETFs. But it obviously bit by bit we overcame all the challenges, and then on April the 11th, the products were launched and listed on the exchanges.
Did it trade first day or?
I think so. We actually
was it your PA account? Was it at Merrill Lynch?
But it was quite funny. Like our head of sales in Germany had actually arranged for 350 million seed.
Wow.
For the two ETFs. So basically, he'd got together a consortium of banks basically to seed it. And I think probably did trade. Our good friend Simon Roche was the trader market maker at the time at Merrill Lynch. He would have supported it. But the beginnings were very slow. But it was just one of those cases of let's get it built, get the product out there, and get the market going.
So Merrill's was the market maker as well, were they?
Would have been, yeah.
Right.
Yeah,
okay.
Yeah.
Okay.
But we then had some of the Bader banks, etc., in Germany, sort of supporting afterwards as well.
Doing it from that perspective. And then you mentioned about the the lack of awareness of ETFs. What was the sort of market awareness of ETFs? I mean, obviously, I still believe we're still telling the ETF 101 story now, and probably will be for the next couple of decades. And it must have been in those days. It must have been basically just even explaining what the word was. Never mind what they were. There's probably no recognition at all, was there?
Yeah, exactly. And it was very new and. it's funny, like I think at the time also like indexing was fairly new as well, so it wasn't well known.
Yeah.
So it was very much a story of persuading investors why they should buy index products, an index tracking product. And I think what we'd find is when we'd visit, say, a wealth manager or private bank saying you should buy an ETF, but then they would always say, I don't get paid to recommend a passive product. My job is to select securities, equities, bonds, or choose mutual funds where I do the research. That's what my clients are paying me for. I'm not getting paid to choose an index product. So it was a very different environment in those days. And what we normally find is that when we went to see these professional investors, they'd say, I can't buy it professionally, but I'll buy it PA for my own portfolio because I think it's a great product. So that's.
I think we've heard that throughout history of the ETF market, isn't it? Like you start off, I've often said to people, like, if we take a product and go and see a bank or an asset manager or whatever and pitch the product, fairly likely they'll start trading it PA first, get used to it, and then obviously work its way into the into all the plumbing. But it must have been. What was the target audience at that point? Like, I mean, obviously now we look at things like robo advisors, neo brokers, private bank wealth managers, institutional clients. I mean, what was the sort of thought process behind? Well, this is the target group that's going to really buy this product.
So I think it's good learning because, like, obviously I worked for Merrill Lynch, a US house, and they'd seen the success of ETFs in the US.
Yeah.
And a lot of the success of ETFs in US was driven by retail investors. And those retail investors were basically people who already had a brokerage account. They would have had an account with Smith Barney, Merrill Lynch, or whatever.
Yeah.
And they were used to trading shares. They were used to buying equities, but used to buying things on exchange. So for them to buy an ETF was a natural progression. What we found here in Europe was the market was very different. Obviously, it's a series of different sort of set of different countries. But what we also found was that the distribution of financial products was controlled by IFAs, was controlled by banks and insurance companies. These were the guys who were basically providing
channels,
providing product investment funds, investment products to investors. In Germany, you had a sort of a certificates and warrants market, which were actively traded, and also in Italy. But these were once again controlled by the banks that offered the products.
Yeah. So the banks were probably pretty resistant to this then, were they?
Yeah, no, it was very much like the first 5 years of ETFs was very slow in Europe. And I think it was very much a case of how do we sort of get the products out there. And I think the biggest breakthrough came in the mid-2000s when basically there was some research out showing that asset allocation was key to running a portfolio.
Yeah.
So rather than being a stock picker or a bond picker in a portfolio, it was getting the asset allocation right. And within that framework, it was all about timing and what products you use. And ETFs, obviously, by virtue of being exchange traded, could be used for both strategic and tactical asset allocation.
Yeah.
So we started seeing the market changing, and this was in the sort of the professional market, fund of funds, discretionary portfolio managers then think, okay, I can add 5% or 10% or 20% exposure to some of these markets through ETFs. And I think also and kind of, I guess we all as the industry made it happen was it was all about access. It was all about accessing markets or asset classes, which you couldn't do through mutual funds or other products.
Sure.
So you guys did the gold, and these were all new because they were basically providing a way to invest.
So just making it very easy for people.
Yeah.
So you probably touched on that a little bit, but how do you think sort of impacted the market long term and short term? When you brought these products, what visible changes did you see as this sort of? You said it was slow, but there must have been sort of like awareness factors and business models changing and new people popping up and asking questions. And how do you think that sort of environment changed as you did it? And did it shock you? Did anything strike you as, I didn't expect that scenario?
Yeah, no, I think from the very beginning, I always felt ETFs were a good product. And in my previous life, before ETFs, I'd worked on a number of different investment products. And there, basically, I'd do one, move on to the next thing. I didn't think 26 years later I'd still be working in ETFs. So there was...
Or that it'd be $20 trillion of assets either, yeah.
So there was an element of, okay, this is a good product. But I guess it's a combination, I guess, a bit of luck. I think one of the things we saw was that cost became a big issue. And I think we actually had the regulators behind us on that issue. So I think a lot of focus especially after the financial crisis, on value for money for investors, transparency. And I think these were two boxes which ETF ticked very much. So I think it played well in terms of growing ETFs, growing the market. And what we found was that, the resistance reduced over time. And what we saw was that, the wealth managers who previously wouldn't have touched an ETF were now open, sort of looking at model portfolios, how they can use ETFs basically as building blocks. The retail market in Europe was still relatively slow. I think that was something that's probably maybe really taken off in the last 3 or 4 years, as you mentioned earlier, with the emergence of neo brokers, robos, etc. But I think that getting into the institutional space was quite a challenge initially. I think the other thing which probably helped was when we launched the X-Trackers platform, we went down the synthetic replication route. And that helped with getting institutional investors on board, because they saw that, okay, I would get exposure to a market like MSCI Emerging Markets or MSCI World. I could do it by buying a fund, or I could buy it by buying an ETF, which is using swap replication. And they liked the swap replication because there was zero tracking error and very closely tracked the index. So I think that also helped.
Because it was more surgical for them,
Exactly. So that, I think, helped in the sort of latter 2000s with the growth of the ETF market in general. So,
and when you launched the STOXX 50 and Euro STOXX 50, in that sort of initial period, what were the sort of common misconceptions that you came across when you started talking to people?
I guess because ETFs are sort of born out of the kind of the equity derivatives part of the world. So in some quarters, maybe I think they were sort of classed together with hedge funds, even because they were seen as exotic,
even though they're the opposite end of the
spectrum.
With
and basically, it was new. I think it's all about these things. I think, as I mentioned earlier, I think part of the initial argument was making the case for indexing, why indexing is can be better than active investing. So I think that was part of the challenge. And I think what we've seen over the last 25 years is now universally accepted that indexing has a place within people's investment portfolios.
Presumably there were people that were invested in index funds at that time, were they? Or did that, what was the sort of life of, the LGIMs of the world providing cheap beta at that time? Did that really exist, or did it coincide alongside ETFs as they went through?
Indexing has obviously been around since the early 70s. And initially it was very much the preserve of institutional investors.
Right.
So it was like the pension funds, insurance companies would allocate to FTSE 100 or whatever is the main benchmark.
Just like a seg mandate or something like that, was it?
Yeah. And there were some funds, but I don't know if you remember, back in, I think, probably 2000, Virgin launched a FTSE 100 tracker as a fund. But that had 100 basis points fee.
The Spider started at 100 basis points, funny enough,
So there was indexing available, but it wasn't mainstream, and it was still high fees for investors. Right. I think obviously the landscape has changed in the meantime. And I think one thing we saw was obviously some asset managers were resistant to ETFs. So their way of offering indexing exposure was to do it through the mutual fund wrapper. So that's why probably in the 2000s, you saw the launch of index funds as well, which
coming together. So as the index story got stronger, then the different options got stronger alongside them as well. Yeah. What's the sort of funniest moment you had when you were working on these couple of products, or funny moments? What was the sort of, Nick mentioned about using his fax machine and everything like that when he was doing gold bullion securities. But what do you have? Is there any anecdotes or funny stories you had during that time?
It's funny, obviously, when we launched in 2000, it was also the time when the internet was developing and is becoming mainstream, and we wanted to set up a website. So with the domain leaders.com, LDRS.com. But then when we came to register the website, we couldn't get the name.
Okay.
So there was somebody else who had the domain. And there was this obscure sort of group in the US, and LDRS for them was long distance rocket spaceships.
Oh, well, there you go.
So they own the domain.
Was that not why you called it that then? Was that not the reason? No.
So initially we had to launch with the domain LDRS
Right.
but then we did purchase the domain from these guys. But
how much was it? Do you remember?
It's a few thousand or 10,000 or whatever.
You probably thought that was a ridiculous amount of money at the time,
you
right?
had to justify why you want to buy it for that much. But yeah, so we got the ticker, and I always look back and think 25 years later, ETFs have gone the long distance, and they put a rocket up the investment industry as well. So
I always wonder, like Merrill's with Leaders and Morgan Stanley with Webbs and all that sort of thing, whether the banks look back on this and think, Christ, what did we miss out on, really? And even when you look at BGI getting sold to BlackRock as well for about $6-7 billion, I think, or whatever it is. I mean, we all saw that Innovator trade, last week or the week before, which was $2 billion on $29 billion of assets, and you just think what these businesses would be worth if they'd kept hold of them, really.
Yeah, and I think it's interesting. Like, I think banks go through cycles where one moment asset managers are flavor of the month, and the banks want to own an asset manager.
Yeah,
and then there comes a time when maybe market stress, or they think, we can offload it and get some money. So obviously that was the case with Barclays, Merrill Lynch to a certain extent when they sold the Leaders ETF, and Merrill Lynch sold its asset management business to BlackRock as well.
That's right.
So in 2006. So all of these things go through cycles, and is very, very much always a discussion at Deutsche Bank as well. With its asset management division. It
was funny when I was at BZW, which was the forerunner to Barclays Capital. Barclays de Zoet Wed Durlacher, as it was in its name, and I remember I think it was 95, 96 when I was there, and there's a big announcement came out that said they bought Wells Fargo Nikko Asset Management. And we were all saying, like, why the hell have they bought this? We're quite a parochial UK investment bank and or even merchant bank, really, and they bought this obscure, well, what to us was an obscure West Coast asset manager, and obviously it became BGI, and the rest is history, really, and but it's quite interesting how all these things wrapped together, what could have been type scenario. But and I mean, obviously, you didn't have a crystal ball at the time, but did you have any inkling how successful the market would be for when you launched these products, and did you understand your pivotal role in being the person that was the architect behind that at the time? Did you have any inkling of that, or was it purely just, well, I've got a job and I'm getting it done, and I think it's pretty cool, but if we get 100 billion in it, it's done really well, as an industry type scenario,
Yeah, no, I think I didn't think didn't think in my time I'd see the change we have seen. I think that was it's been a pleasant surprise. But I think the one thing that always convinced me, as I said earlier, was that I thought they were good products. And one of the things I learned in my first job, which was when I worked, was the CEO and co-founder would always said to me was that when you build an investment product, you should always ask the question, what's in it for the investor? And why should I buy it? And I think ETFs always tick those two boxes for me.
Strange you need to ask that question, isn't it?
Yeah, and exactly. But you see a lot of what I call useless innovation in the market as well. So as a product, I think I was always convinced. And then once you obviously understand what the landscape in Europe is, what the market is, and you obviously had certain quarters who were resistant initially and maybe didn't want to change. And as I mentioned earlier, also that with some of the regulatory tailwinds, I think it's got us to where we are, where ETFs are now 20-odd% market share in Europe, 40% market share in the US, and but would never have predicted it. And I think at the end of the day, I think investors have got a good deal out of it in the sense, if you look back in the late 90s, 2000, where mutual funds, now I think last year they celebrated their 100th anniversary, so they've been around a long time.
And investment trusts as well,
One question you would ask is, were investors actually getting a good deal? Were they getting value for money? How often could they look at their portfolio holdings? Probably maybe twice a year when you looked in the semi-annual and annual accounts. So
when it came in the post.
Exactly, So I think when you look back, and obviously I didn't have the vision at the time what it would become, but it was when you look back, you think, oh, wow, we have changed things for the better. And at the end of the day, like, again, it sound a little bit maybe evangelic or whatever about it, but sort of ETFs have been a good product for the market. And a few years ago, I was at some talk, and there was a professor from the Oxford Business School, and he said, which made me smile, was that ETFs have been the greatest financial innovation since the ATM.
Is that right? Yeah. So, it's interesting way to look at it. Yeah.
I think like we've all played a part
Yeah.
in changing the industry and changing the market, and it's satisfying to see that.
Totally true. I think for me, I think it's been very synergistic and coincidental with the rise of e-commerce and ETFs. You know, I think those two things went hand in hand together. And I'm not sure, I mean, I don't know if you thought that at the time, you know, probably didn't have an awareness of e-commerce. You know, you tried to buy your website, but you generally didn't think that sort of ability for people to instantly transact and get access. I mean, you talked about access before, but that sort of whole sort of instantaneous Amazon Prime gratification of the economy, you know, ETFs are the only thing that lean into that, really, in my opinion.
Yeah, I agree. And I think especially for the retail market to take off, I think it needed, like I remember in the early 2000s, we all had broadband, but it was shit. It wasn't very good. It was slow, whatever. But then
it's that technical term, that one, is it? Yeah.
But it was, you have a modem or whatever. So you couldn't actually trade like you wanted to. So it's only once
take you 10 minutes to get a round trip or whatever.
Exactly. Yeah. So it's only once the kind of the broadband technology, internet improved. I think then we saw obviously retail investors can come on board.
Yeah. No, I think that's exactly right. And I always say the power of an ETF. You know, when we talk to one of our clients, say this is the first time my mum can buy your product, right?
Yeah, exactly.
She can buy one share on the same basis that Fidelity can buy 1 million shares, right? You know, so that to me is the e-commerce power and that democracy. Is what we probably always knew, but we didn't realize how powerful it was, I don't think. Yeah. So I mean, it's a really interesting. You know, you wonder where that's going to go next, really, from a perspective. Did you have any idea where your role would develop as well? I mean, obviously you started at Merrill's. You know, how big was the team, by the way? You know, what did the team look like that you worked with at Merrill's on this? Was it pretty much you, or was it a couple of you, or did you use all the different departments? You know, how was it structured in Merrill's to get this done?
Yeah, basically it was me from a project management and product development perspective. So it was my job to get it done. And then I think we had sort of a lawyer, basically Ed, who was working with me, sort of kind of full time to do all the legal and regulatory stuff. And then we were obviously working with Bank of New York to do that. The law firms we were using at the time, Arthur Cox, so they were very integral to how we developed it. And then
that's so far back. Was Arthur actually part of the transaction, or was he not? No.
It was a small team at Merrill's, and then once the products were launched and listed, then we had Simon Rush on the ETF trading desk, supporting the product, and then basically we were.
He also secretly told me he hated making markets in ETFs.
Yeah. I think the systems weren't quick enough for him to stop being arbitrage. We won't
tell him, but when I was at Susquehanna, we used to make a lot of money on Simon Rush making markets in ETFs. But that's time for another story, another time. Yeah.
But I think like at Merrill's, like we didn't have a dedicated sales team or anything. So the ETFs at the time were pushed, or not pushed, but sold through the equity derivative sales or the Delta One sales. And then you soon realize was that because the margins on ETFs were lower, but the sales teams didn't really have an incentive to sell the products either. So it was a.
Did you find yourself doing a lot of sales as well, getting out like a product expert type with the
I'd go out as a product expert supporting the sales and everything, and do conferences and things like that. So
was it hard to get meetings in those days, or
would have been sort of. I think that changed, as I said.
None of my 5 a day KPIs, they would have been hard to meet, would they?
Yeah. So like in 2000 up to 2003, Merrill's obviously had the business, and you'd see that it was tough. And then I had a 2-year break. I was still at Merrill's. I didn't move with the business to iShares. But when I came back in 2006 with the X-Trackers, you saw that the market had changed. I think that you're now saying how
the traction was starting.
It's starting to get. And from the mid 2000s, I think it was easier to get meetings and people were willing to listen. So I think we kind of reached that flipping point where the market was accepting, the professional market, and they were saying, okay, maybe this is good. I need
to know something.
And I think it also helped with the growth in the number of products. So like the first 2 products we launched were on European benchmarks. iShares launched a FTSE 100, and then you kind of evolved, and landmark products like the MSCI World, MSCI Emerging Markets, the first fixed income ETFs. So basically this broadened the toolkit for investors, and you can go in
Yeah.
and tell a story. You can go in and say,
And they were all really challenging, all those products to get going. I remember
exactly.
just from a market making perspective, you know, it was always a challenge to figure out. I remember first two products iShares gave us at Susquehanna was new ones where when we signed the market making deal was IJPN and FXC, you know, Japan and China. And we thought, well, how the hell are we ever going to hedge these?
Exactly,
you know, but we didn't tell them that. We were saying, oh, no, this is dead easy. You know, we can figure this out. But we were scratching our heads for a long time. And you'd laugh at that today, really.
Yeah.
Why did Merrill shift the business on then? Why did they sell it to iShares? What was the vision or lack of vision in that? You can say it now. It's 25 years later, mate. So it's or 22 years later. So it's so it's okay now.
Yeah, no, I think Merrill's got into the ETFs to kind of drive the trading volumes in ETFs.
Yeah.
So basically, they wanted to see volume sort of on exchanges, and then they, as a brokerage, they would sort of make money revenues on that and through the market making. After the leaders were launched, obviously we had the .com crash. We also had things like 9/11. Merrill Lynch went through a lot of change, and they actually, at its peak, I think in 2001, Merrill Lynch had something like 72,000 people. And then by the end of 2003, it had gone down to 48,000 people. And I'd be on the trading floor and you'd see the person sitting as you go down the road, the desks, people getting chopped as they go along.
With a box.
And eventually I think ETFs were seen as low margin. It hasn't made the money, or it hasn't replicated what happened in the US. So they decided that we want to exit, and that's when the discussions with the BGI iShares team started.
Was it a giveaway trade, or did they make good money on it?
And they made good money. It was a decent trade. So we didn't. I think the bank didn't lose out as a result of its investment in the ETFs. But yeah, it was one of those things where I'm sure. If you look back, you wish you'd kept it. But at the time, the bank felt it was the right decision.
Hindsight's the best trader in the world, isn't it?
I didn't agree with it, but at the end of the day, it was right for them.
So where did your career go from there then? I mean, obviously, you know, they sold the business. You know, did you stay at Merrill's for a little bit, or did you go straight into X-Trackers? How did that?
Yeah, no, I stayed on at Merrill Lynch for a couple of years. So,
what were you doing over that time?
Sort of mostly still a sort of what I call a buy side job. So at the time, UCITS 3 had come out, and there was basically an opportunity to use swaps and derivatives within UCITS funds, and
which is ideal for banks, right?
Yeah. So I set up their structured funds platforms, and basically we did it.
Would that be what you think is QIS now? Is it, or
probably would be? Yeah, that's the incarnation. That a lot of banks. That's why they have these platforms. So in the early 2000s, it was something which a lot of banks developed. So I was doing that for a couple of years, and but as I said earlier, like I always had an affinity with ETFs. So when I got the chance to join Deutsche Bank, it was like unfinished business.
Yeah.
So and
what vision did they sell you then? Did they sell you a vision of where X-Trackers ended up, or was it like a little bit more? Because it was originally in the investment bank, wasn't it? Not in the not in the asset management.
So when I joined in 2006, they actually had 2 ETFs already.
Right.
But they were basically launched from their asset management division.
Right.
And, and it was a DAX and Euro STOXX. But at the time, the CEO of asset management didn't like ETFs or didn't like index products.
Yeah.
So basically, he was happy for the investment bank to take the lead in developing the ETFs. And he had a couple of conditions. One of the conditions was that couldn't be done physically, so you had to do it swap based.
Okay.
And then also Deutsche Bank, the investment bank, couldn't be the asset manager.
Right.
So we had to outsource the investment management, and we use State Street Global Advisors to be our investment manager. So basically, we were like, after the internal machinations of who does what. Basically, the investment bank got the green light to build the ETF business. And
did they put a lot of money behind it right from the start, or was it like a bit of a cottage industry that
No. The plan was to go big. Plan was to basically, at the time, Lixor had been in the ETF market, and they were the number 2 player. So the plan was to catch up Lixor. And I think within the first sort of year, we launched probably 50-odd products.
Wow.
So we launched a broad range.
I vaguely remember you guys really coming in with a big fanfare, you know, and particularly around all the benefits of the swaps and the tax uplift and all those types of things.
So I think we launched initially with 8, and that was in January 2007. And then by the middle of the year, the fixed income team launched the ETFs. So we probably had 50. They would
Right.
launch a whole series of emerging market, all the building blocks. Basically, we bought them by the summer of 2007. And then by the end of the year, I think, we probably had 50 ETFs. And many of those products, most of those products are still around.
They're still around,
core. And like I think one of the biggest asset gatherers in the last couple of years has been the Euro overnight ETF, EONIA. And that's, sort of that product was we always talk about right product at the right time.
Yeah.
When we had the financial crisis, there was no sort of safe haven money market funds were under. Our Euro money market ETF basically went from about a couple of 100 million to 8 billion within the space of 6 months because it was seen as a safe haven.
Yeah.
So you kind of get a bit of luck as we know.
I often look at ETFs in that sort of scenario, almost like the rain starting, you just like buckets filling with water. If you can get them at the right point where the rain's there, you just need to keep adding the buckets to fill it up. Really, it's quite incredible, really, when you see that pop.
Yeah, and I think as you've experienced, is that all along the way, people have always expected ETFs to blow up or be a failure, and it's always given me satisfaction that whenever there's a crisis or a situation like Brexit or COVID or as I said, the financial crisis and the Euro crisis, ETF actually each time came out stronger and bigger and better.
Almost proof of concept, isn't it? In those scenarios.
So it's always, whenever something happens now, I don't panic. The first one it happened, obviously, when I was at Merrill Lynch, 9/11. That was a big thing, and the products continued to trade, and everything was fine. So you sort of over time realize that so that there is an
almost
ecosystem
there for that reason. But I think even at the market making level, you always think those guys are under massive stress in those environments, but that's actually when they make all their money. They just have stellar years in that scenario because they're brave enough to step up and do that. And in a way, the ETFs are an extension of them in a way, isn't it? You get their expertise and their knowledge, and you talked about it, the evangelism of ETF. I always class myself as an ETF boonie. It's almost like a cult for me. It's, in some ways, if I'm not delivering the ETF, somebody else is, and that's successful, I'm actually take some pride in that as well as, as being part of that ecosystem, really. And in some ways, when I first started in ETFs early 2000s, similar to yourself when I was at Susquehanna, it didn't feel small back then in a way, and it feels a bit smaller now, which is, I know, is a bit of a bizarre comment, but it just didn't feel, and there's a lot of people still around, isn't there, from those days, that you come across in different guises or whatever.
Old time is still around, but if you look at the industry now, I was at the ETF Stream Awards the other week, and they had 450 people in the room. They're all so young now as well. So it's the next generation. A lot of the people probably weren't even born when the first ETFs were launched.
I sort of feel sorry for that generation because they don't done the bits that you've done and I've done, where it's real nitty gritty. I call it putting the bolts in the boat, right? That they haven't put they steer the boat and they sail on it, but they don't put the bolts in it. So they're understanding. I mean, it must be hellish working at iShares to try and understand the ETF business because everybody's role must be so narrow because there's so many people there. That holistically, who's got an overview of the business? I mean, I think that people like myself and you and Nick, and other people out there, we pretty much know every facet of the business, even though, you may lean more in product development, I mean, lean more in business development, whatever. If there's a problem, we can always dive in and sort it because we sort of know that, that fundamentally what the blueprint should look like, right? And there's very few opportunities and people around for like that now, really, I think. I mean, I do actually hope that at some point we see a wave of entrepreneurs come into the ETF market in Europe because we've not really seen that, whereas the US has got that in spades. And I think in a way, doing the white labeling sort of helps that happen, and I think we're starting to see the germination of a bit of that. But that's one of my wishes that I'd like to see for the ETF market. What's your sort of wishes that you'd like to see for the ETF market? If you step back and sort of see it, how you'd like it to develop, what would you like to see, product or structure or retail? What's the areas you think would be the most interesting going forward?
I think obviously the ETF wrapper started very much as an indexing vehicle, and I think ETFs have basically brought indexing to the mainstream over the last 25 years, and I think most people now understand the benefits of indexing.
More ETFs than stocks,
exactly. For the next stage, I think what ETFs can do is basically become the wrapper of choice for liquid investment strategies, be it active or passive. At the end of the day, and I think that's where I see it. And obviously, we as a business have seen that coming through. But I think it's still not a case of just stick anything in it and it will be a success because it's an ETF wrapper. I think the products still have to be good.
Yeah.
And I think one of the things which we've seen in the US that's been successful has obviously been these defined outcome sort of products that provide a purpose, basically be it income or capital protection. And I think there's room for probably that in the European market at the moment. Obviously, we see a lot of active asset managers launching enhanced index type strategies, but that's just competing in the same space. And you might as well just buy a S&P 500.
I can't quite understand what's the difference between smart beta and that, really. You know,
exactly.
It seems to be wrapping up again.
Yeah. So, but if you have products that still provide access to new markets, new asset classes, or deliver an outcome for investors, I think that's where there's a big opportunity, I think, for the market to grow, because I think the way people invest is changing anyway. And I think a lot of the change has to come from the traditional asset managers to adapt their business models to the wrapper, rather than do what they've done for the last 100 years in the mutual fund, bring it in.
It's quite challenging for them, I think.
They have to change.
Yeah, I think it's quite but I think the good thing about the European market, I always believe, is you've almost got a blueprint of what's going to happen by what's happening in the US. You know, it's usually 3 to 5 years ahead. Now, I'm not saying it happens exactly like that, but it's pretty nailed on in terms of the macro level. You know, like we saw that advent of all the active products, all the defined outcome. You sort of know it's coming, and we sort of at the brunt of that. We get that up front, don't we? You know, so I do think there's, you know, in some ways, I often feel that, you know, as an entrepreneur in the ETF market, I've made my money by looking at what's happening in the US and seeing what's missing here and getting ahead of that. Now, timing can always be a bit tricky with that. But ultimately, the direction of travel's not. You know, the direction of travel pretty much is nailed on, isn't it?
Yeah, great. Yeah.
You know, I think that's really going to be, you know, quite interesting. You know, I mean, there's lots of estimations that the market's going to go from 20 trillion to 50 trillion, 60 trillion. You know, I even some ways think that Europe could end up bigger than the US over time, just simply from demographics. There's twice as many people in Europe.
Yeah.
You know, and you've got, like, you know, countries at the bottom end of the scale that are adopting ETFs, like Poland, that's only got 15, all the way to Germany, that's got all these savings plans. But the direction of travel is all in the direction of ETFs, isn't it?
Yeah, no, I think any market, I always use the analogy of the landline and the mobile phone, where if you don't have a presence in a market, or if you're not offering mutual funds.
We'll need to subtitle that for the kids, by the way, watching this, because they won't know what you're talking about. But
yeah, but you just basically skip the landline and go to the ETF wrapper, skip the mutual fund, go to the ETF wrapper. I think that's the way. And if you're an asset manager who's looking to come from the US or come from Asia into Europe, then your starting point should be the ETF rather than the mutual fund.
You know, going back a little bit to the history side of it, I think you might have touched on this before, but what do you think was the biggest turning point or turning points in the ETF industry? I mean, you talked about regulation, you know, passive investment, that sort of thing. You know, what did you wake up and think, we're finally in something here, this is going to absolutely be massive? When did that dawn on you?
Yeah, I think, like, as I mentioned, sort of change in investing and changing how asset allocation was done. And I think that was in the mid-2000s, where we saw that people were saying, or the research was showing, was that it's getting the asset allocation right rather than what you invest in. And that sort of coincided with the acceptance that index products could be a way to get that exposure. And what we used to see in the early days was, if you wanted exposure to US equities, you'd buy an S&P 500 ETF. And then if you wanted to buy an active fund, you could then do your research and basically do it. Or you might find that the active funds all underperform and you just keep it with the S&P 500. So I think we definitely saw that. I think the other thing was the growth with the institutional market in the late 2000s was, and I think, as I said, like at Extract, because we very much focused on the benefits of synthetic replication, swap-based replication, the accuracy, the cost, and the low tracking difference, like tracking error. And I think that brought along a lot of institutional investors, and we would have large pension funds, insurance companies allocate.
It would have been very au fait with trading swaps. And
exactly. So they were very happy to do that. So that helped to grow the market overall. And I think that obviously gave it the momentum. And I think that brought other people in. So you had people like UBS, even Amundi at the time, Credit Agricole. They'd all launched ETFs in the early 2000s, but they kind of went dead or dormant. And then they relaunched them in the late 2000s when they saw the market.
UBS had the Frescos originally, didn't they?
Frescos. Credit Suisse had X-Match, but all of these businesses were revitalized in the late 2000s. on the back of what we did at X-Trackers, basically. Yeah. So
I mean, what you've not touched on with the derivative side of that is the battles you guys had with iShares, right?
Yeah.
You know, and obviously, to me, in some ways, I felt that sort of paused the ETF market in Europe. You know, damaged the ETF market. You know, probably one market share in the 100 people that were involved. Just plug a number, 100 people involved in ETFs, but the 10,000 looking to get in just suddenly said, "ET what? Not interested in that." Got put off by it. You know, what was it like to be in the middle of that?
Scary. Yeah, that was one moment where, because I think it was in April 2011, basically 3 research papers came out from, I think it was the IMF, the Bank of International Settlements, and one other, basically saying that synthetic ETFs were toxic.
Right.
And there was a certain large asset manager who was behind them. And basically, they basically sowed doubt in investors' minds, basically saying, do you know what you're buying? Can you see what's inside it? And basically from 2011 to end of 2012, basically, I spent a lot of time basically talking to regulators, talking to all kinds of bodies, basically stock exchanges, educating. And at the time, we knew that within the UCITS framework, we were actually not doing anything wrong. So UCITS allowed for synthetic replication. They had rules on counterparty exposure. They had rules in terms of what you could use in the collateral basket or the fund basket. And we were compliant with all of them. I know.
Yeah. And it was all very transparent as well, wasn't it?
Exactly. Yeah. And one of the things that came out of it was that it raised awareness of the products. But as you say, it did stall the growth. And what we also found was that, and I always say this, is that we won the regulatory battle.
Yeah.
But we lost the war. So basically, 2012 was a turning point for the X-Trackers platform because we were in the bank. Then during 2012, we transitioned to asset management and we changed our business model. So we went from 100% synthetic to transforming the business to launching physical replication, switching funds over. And basically, by the time I left in 2000, it was 75% physical, 25% synthetic. We still kept some synthetic.
And that pivot was massive, right? I mean, that was a big decision, but probably ends up looking like the right decision as well, doesn't it? In terms of the growth and the extent of the business.
Exactly, yeah. So I think the good thing at Deutsche and DWS, so the asset management, was people believed in ETFs. It was backed. And basically they were happy to invest to transform. So obviously we had to build a portfolio management team. We had to build the infrastructure to support it. And we were given the chance to do that.
And the irony wasn't it, that, you know, with the blanket being raised on synthetics, it also raised the blanket on stock lending, didn't it?
Yeah, exactly.
You know, which at the time iShares were taking massive revenue from stock lending, not even self-indemnifying the funds. So if there's any losses, the investor bore it, but got none of the returns.
Yeah. And
also the collateral that people would use against the lending was completely invisible to the investors. So there was a huge amount of high standards on the swap side, but not particularly on the physical side.
Exactly. Yeah.
You know, so I think from that perspective, and I think ESMA, if I remember rightly, in 2012, 2011, actually opined against. When they looked at the structures, they actually opined against stock lending and said that needed to be tightened up.
Yeah, and I think it was the disclosures. So basically, they required that if you were securities lending, you had to provide details of what was lent out, how much was lent out, what the collateral haircuts and everything were as well. So that was one of the things.
So put them on a level par, wasn't it? Really?
Exactly. Yeah. So
I mean, I remember when I was at Susquehanna, and we obviously would making the markets for iShares, and we knew their products inside and out. And I would talk to iShares staff about stock lending. They would deny they even did it. No, and I don't think they were lying. I just don't think they knew.
Yeah, they didn't know.
They just really didn't understand the products, you know, and it was quite amazing, really.
Yeah.
And I even find it even more amazing today how Larry Fink's saying, well, they're getting back into the swap game. You know, we all know they had Project Orion back in the day and just couldn't make it work economically, so that's why they didn't like swaps. It wasn't because they didn't want to do them. It's just they couldn't make money from them because they didn't have a balance sheet. But the reality is now saying the world's changed with swaps, counterparty risk, sophistication of systems. It's not. It's exactly the same as it was.
As I said, like UCITS always had a very good framework for managing risk and managing investor exposure. So, and I was always convinced we never did anything wrong, and we were always acting in the best interest of investors. So.
Yeah, no, I think that's a really interesting point in history, and I do think the ETF market would probably in Europe be probably double the size today with compounding.
Yeah.
If that hadn't happened, because I think they won the market share, but they lost bringing those guys in who would be looking at ETFs on the periphery, but would have been getting involved and coming out. I think that stalled that by about 3 or 4 years until people settled down and like you took action and various other people took action.
And I agree. And it was quite funny at the time was that when we were sort of defending swap-based ETFs, one of the biggest funds, the UK IFAs or wealth managers were recommending to their clients was the GARS fund, the Standard Life GARS fund, which was a global absolute return strategy, which was full of derivatives. So I'd be in a room with these guys and saying, you know what's inside those products? You know what they're buying? Swaps and derivatives, But they would say, no, it's a good product, it's Standard Life. So it was, sort of very much an education thing.
Because in the mutual funds, I remember as well looking at, I think it was a multi-asset fund, mutual fund by iShares. Not by iShares, but by BGI BlackRock, whatever they were at the time. And it basically summarised and said we can use CFDs, swaps, whatever. Basically, we use anything we want. We have freedom to do that. And if you look at it, if you remember it rightly, the largest swap-backed product in the world was iShares China in Hong Kong. At the time, that was backed by a non-collateralized promissory note from Citibank, right? That was the craziness of all this, really. But anyway, enough on those days. But it is nice from the history perspective. Where do you see the future of the ETF market from here? Obviously, you've got that sort of whole tokenization thing on the horizon. You've got private capital. Obviously, you've got this massive growth rate. I almost call it the ETF black hole, how everything gets sucked into the black hole. You mentioned the liquid strategies. Where do you see that sort of, because they're still the Wild West frontiers, the private capital and all those. Where do you see all that coming in?
Yeah, I know there's always talk of what's the next big thing or the next innovation, and I'm firmly of the view that if it's not liquid or if it's not tradable, then it probably shouldn't sit in an ETF. What I do think is that if you want to develop those underlying, so if you want to develop private credit, private market exposure, then ETFs can help that market by providing the ecosystem. But these things have to be opened up. They can't be opaque. They can't be like a closed access or anything like that. So I think and we've kind of seen it with things like high yield bonds, emerging market bonds. They were not accessible before, but ETFs have made them accessible, and they've, in many ways, the ETF liquidity is greater than the underlying, so people can access it. And I think ETFs can play the same role with some of these other less liquid segments. But I don't think I would also ask the question, what's in it for the investor? Why should they buy it? Is it a good product? Is it just the fact that the asset manager can charge high fees? That shouldn't be the reason. It should be, am I getting a good exposure? Am I going to get long-term benefits by investing in these products?
And you've just seen it. We've just launched catastrophe bonds, haven't we? Which I think there was a few doubts on being able to do that.
Yeah, exactly. Yeah, but hopefully, obviously, that is a decent sized market, and there is sort of not fluid, but at least a secondary market out there for those products, and hopefully by having the ETF, we can grow that segment. Yeah.
And I think you've seen it with the track record of things like gold and precious metals and bonds that price discovery that was difficult before. Has been much improved by ETFs. That you actually get a reference price and executable price. Whereas that wasn't really prevalent in those OTC markets. You would probably have to go to a lot of IDBs. Where the gold market has the 2 daily fixings. It's sort of brought that exchange traded nature to it. That equity trading, which I think has been very beneficial to those asset classes.
Yeah, I agree. And you asked about tokenization. I don't really know actually. I think sort of for me, obviously.
I think ETFs are tokens already.
Yeah, almost.
To a certain
almost
extent.
The kind of the next transition. But in terms of obviously making that the next big thing, I think ETFs probably still have another lifespan of at least 15, 20 years.
Particularly if you bring in re-engineer the blockchain into ETFs,
But I think obviously, if you can open up new markets in a liquid, transparent way, then whatever the wrapper is. And I think the whole industry, we've been doing ETFs for 25, 26 years. Asset management, mutual funds been around for 100 years. I think, and we've seen a lot of change in the last 25 years.
Yeah.
I think there's probably going to be 25 years worth of change in the next 5 years in terms of the industry and where it's going. And I think, ETFs will play a big part.
Will you be around for the next 25 years, Manooj?
I hope so.
Well, you'll be around, but maybe not working in the ETF industry.
Yeah, exactly. Yeah.
So we're going to finish up now. What piece of advice would you give your younger self now? If you were sitting in that office in Merrill Lynch, what piece of advice would you give yourself now to prepare you more for the future?
I think one of the things I've always felt was that especially when you're working in big organizations, is don't pretend to be someone you're not. Be yourself. I think that's quite important. I think don't change the way you work or don't change the person you are. I think sort of be yourself. And the other thing which I always say is, learn from your mistakes. And if you go through your career and not have many regrets, I think that's always a good thing. And obviously we're all faced with making decisions, but the main thing is don't have regrets. If you do, go and change it and do something about it. I think that's what I always
prepare for next time, right?
Yeah, exactly. Yeah.
Very good. Well, thank you, Manooj, and congratulations on being the father of the UCITS ETF market. And hopefully this has been a good statement of history for people to take from here, really.
Yeah,
and obviously with the materials and everything, it's very tangible. And thanks for bringing the industry to everybody. Yeah.
Thank you.
Cheers. Okay.